Marcus and Derek grew up on the same street, same city, same jobs out of college, same $72,000 salary, same $40,000 saved up by age 28, same everything, except one decision. Marcus bought a house, 3-bedroom, 2-bath, $380,000, put down $40,000, just over 10%. Locked in a 6.9% mortgage rate in early 2024. Felt like he was finally doing the adult thing, building something real. Every mortgage payment, he told himself the same thing. I'm not throwing money away. Derek rented 2-bedroom apartment, wanting $850 a month. Kept his $40,000 invested. Everyone at work told him he was wasting money. His parents called it paying someone else's mortgage. His girlfriend asked when they were going to stop renting and get serious. Derek smiled and said he was thinking about it. Here's where it gets interesting. They both think they made the smarter choice. They're both partially right and both missing. The number that actually decides this. And that number isn't the mortgage payment. It isn't rent. It's something most people never calculate. We'll get there. But first, let's make sure this comparison is completely fair. Same starting age. Same income. Same city. Same $40,000. Marcus uses his $40,000 as a down payment. Derek keeps his $40,000 in a broad market index fund. Will use the S&P 500's historical average of 10.1% annually per data from macro trends going back to 1928. Marcus's monthly mortgage payment on a $340,000 loan at 6.9% over 30 years, $2,242 per month. That's principal and interest only. Derek's rent, $1,950 per month. On paper, Marcus looks like the obvious winner. He's building equity. He owns an appreciating asset. In 5 years, 10 years, that house is going to be worth more. He can sell it. He can refinance. He's not handing money to a landlord every month. There's a finish line. At year 30, he owns it outright, and home prices historically appreciate. According to the Federal Reserve Bank of St. Louis, the median U.S. home price has increased roughly 4.3% annually over the last 30 years, adjusted for all the ups and downs along the way. So Marcus looks solid. Derek looks like the guy who never committed. That's the surface. And that's where most people stop. But there's a layer underneath, and once you see it, you can't unsee it. Loop 1. Open. There's a number hiding inside Marcus's mortgage that almost nobody calculates in the first 5 years. We'll pull that number out in a few minutes. Let's start with what Marcus is actually paying. His mortgage is $2,240 a month. But that's not what home ownership costs. First, property taxes. The national average effective property tax rate is 1.1%, according to the Tax Foundation. On a $380,000 home, that's $4,180 per year, $348 per month, added to the mortgage. Second, homeowners insurance. The average annual premium in the U.S. in 2025 is $2,270, according to Bankrate. That's $180 per month. Third, maintenance and repairs. The commonly cited rule is 1% of home value per year for maintenance. But research from Harvard's Joint Center for Housing Studies puts it closer to 1% to 2% annually for homes over 10 years old. Let's use 1%. That's $3,800 per year, $317 per month. And that's the floor, not the ceiling. So Marcus's real monthly cost of home ownership. Mortgage, $2,242 property tax, $348 insurance, $189 maintenance, $317 total, $3,096 per month. Not $2,242, $3,096. That's the number everyone sees. Here's the number nobody counts. Derek is paying $1,850 in rent. Marcus is paying $3,096 in true housing costs. The monthly gap is $1,046. Derek takes that $1,046 in every single month and invests it. Same S&P 500 index fund, same 10.1% average annual return. Now here's what that looks like over time. We'll come back to the full 10-year picture in a moment. But first, let's talk about what Marcus actually owns in year 1. Of that $2,242 mortgage payment, how much is going to equity? In month 1 of a 30-year mortgage at 6.9%, roughly $1,956 goes to interest. Only $286 goes to principal, per the standard amortization schedule on a $340,000 loan. So Marcus is spending $3,096 per month to build. $286 in equity. That's the number almost nobody calculates when they sign the mortgage papers. But here's what changes this entire picture, and it's the reason this comparison is more complicated than it looks. Mini rehook. Before we run the 10-year numbers, there's one more cost on Marcus's side that most calculators completely ignore, and it might be the biggest one: PMI, private mortgage insurance. Because Marcus put down 10%, not the standard 20%, his lender requires PMI. According to the Urban Institute, PMI typically costs between 0.5% and 1.5% of the loan amount annually. At 1%, that's $3,400 per year on Marcus's $340,000 loan. $283 per month. That brings Marcus's real monthly cost to $379. The gap between Marcus and Derek is now $1,529 per month. Marcus pays PMI until his loan-to-value ratio drops below 80%. At his current amortization rate, that takes roughly 8 years. Now, let's run the 10-year numbers, real ones. Marcus at year 10, home appreciation at 4.3% annually. A $380,000 home becomes roughly $578,000 by year. His remaining loan balance after 10 years, approximately $295,000 gross equity, $578,000 minus $295,000. $283,000, but here's what he spent to get there. Total mortgage payments over 10 years, $2,242 x 120 months, $268,800. Property tax, $348 x $120, $41,160. Insurance, $189 x $120, $22,680. Maintenance, $317,120, $38,040 PMI, first 8 years, $283 x 96 months, $27,168 total spent, $398,448 over 10 years, plus the original $40,000 down payment. Total out of pocket, $438,448 equity gained, $283,000 net position after 10 years if he sold today, roughly $283,000 in equity, but he spent $438,448 to get it. And selling costs him another 6% in agent commissions, closing costs, and transfer taxes, roughly $34,680 net realized gain after selling, approximately $248,000, but Marcus hasn't sold. He still has the asset. So his real wealth position is $283,000 in equity on paper. Derek at year 10, total rent paid, $1,850 x 120 months, $222,000. Gone. Correct. No equity. No asset, but his $40,000 initial investment at 10.1% annually for 10 years. $105,100. His monthly $1,529 gap invested at the same rate for 10 years. Approximately $311,000. Derek's total investment portfolio at year 10, roughly $416,000 liquid. No selling costs. No maintenance surprises. No PMI. Withdrawable if needed. The hidden number in Marcus's mortgage, the one almost nobody calculates, is that his true equity building rate in year 1 is $286 per month. Not $2,240. The mortgage payment feels like savings. Most of it is interest. Marcus, $283,000 in illiquid home equity. Derek, $416,000 in liquid investments. At 10 years, Derek is ahead by roughly $133,000, and that is not what most people expect to hear. But before you conclude this, there's a scenario where Marcus wins, clearly, and it depends on one variable. We'll get there. And honestly, Marcus isn't wrong. He's just working with incomplete math, because buying does several things investing cannot. 1. Leverage. Marcus controlled a $380,000 asset with $40,000. That's 9.5 to 1 leverage. When the home appreciates 4.3%, he doesn't earn 4.3% on $40,000. He earns 4.3% on $380,000. That's $16,340 in year 1 from appreciation alone on a $40,000 investment. Leverage amplifies gains in a way a simple index fund investment of $40,000 cannot match in year 1. 2. The forced savings mechanism. Every mortgage payment builds equity, slowly at first, faster later. For people who struggle to invest consistently, Home ownership is a forced savings account with a physical lock on it. According to the Federal Reserve's Survey of Consumer Finances, the median net worth of homeowners is $396,200 versus $2,400 for renters. That gap is enormous. Now, some of that is selection bias. Homeowners tend to be older and higher income, but the forced savings effect is real. 3. Inflation protection. Marcus locked in his payment in 2024. In 2034, he still pays $2,242 per month in 10-year-older dollars. Derek's rent doesn't stay at $1,850. The average U.S. rent has increased roughly 3.1% annually over the last decade, per the Bureau of Labor Statistics. By year 10, Derek's rent is closer to $2,504 per month. That changes the gap significantly. The monthly difference narrows. Derek has less to invest. His portfolio shrinks relative to our earlier projection. Run it with realistic rent increases. Derek's 10-year portfolio drops from $416,000 to closer to $340,000. Marcus's equity stays at $283,000. Now the gap is $57,000, not $133,000. 4. Long-term, buying almost always wins. At 30 years, Marcus owns the house outright. No payment. In retirement, his housing cost drops to taxes, insurance, and maintenance, roughly $850 per month total. Derek is still paying rent, which by year 30 at 3.1% annual increases is closer to $4,400 per month. That's the long game case for buying. And it's a strong one. The one variable that decides this, the one Marcus needed to calculate before signing, is time horizon. Here's the principle this entire comparison resolves to. Buying wins when you stay in the home for at least 7 to 10 years. You can genuinely afford the full cost of ownership, not just the mortgage payment, and your local price-to-rent ratio supports it. The price-to-rent ratio is simple. Take the home's purchase price and divide by the annual rent of a comparable property. If the ratio is below 15, buying is likely the better financial decision. Between 15 and 20, it's a toss-up that depends on your situation. Above 20, renting and investing, the difference is almost always the stronger financial move. In cities like Austin, Denver, and Miami in 2026, that ratio is hovering between 22 and 28. Renting and investing wins in those markets right now. In cities like Cleveland, Detroit, Pittsburgh, and Memphis, the ratio sits between 10 and 14. Buying wins clearly. Renting wins when you're in a high price-to-rent market, your time horizon is under 7 years, and you actually invest the difference. That last part is the condition almost nobody meets. The math only works for Derek if Derek actually invests the $1,529 gap every month. If he just spends it, Marcus wins by a landslide, even in an expensive market. Now, Marcus and Derek, what should they have done differently? Marcus should have known his real monthly cost before signing. Not $2,240, $3,379. If that number exceeded 30% of his take-home pay, the house was too expensive. Not the mortgage, the house. Derek should have run his local price-to-rent ratio, and he should have automated that monthly investment gap the same day he signed his lease, because the math only exists if the investing is real. Ask yourself one question before you make this decision. Not, can I afford the mortgage? Ask, can I afford the house? Because those are two completely different numbers, and confusing them is the mistake that follows people for 30 years. If you want to see exactly how this plays out when you factor in a market crash, what happens to Marcus's equity and Derek's portfolio when values drop 20% in year 3? That's the next video, because the answer might change which side you're on.